Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for over a decade. It is outstanding. He covers a lot of the economics data for GDP, inflation, jobs reports. He is John Williams of ShadowStats. John, thank you for joining me today.
Oh, Jason, thank you for having me.
So, John, I've been following your work for, I think, about 15 years now. We're recording this interview on Monday, August 28th, 2023. I think we're going to get the inflation data out later this week. I want to get your thoughts, though, on inflation and the inflation data. But first, I want you to talk about your background, because it seems that there's a lot of misinformation going around financial YouTube and financial Twitter about your background. I had one guy on who's a large Bitcoin following. He said that you're this kooky libertarian who makes things up. So just please talk about your background as a PhD economist, the degrees you earned, the jobs you took. I know you did a lot of consulting economics for a lot of large companies. Didn't you also work for the government in the Bureau of Labor Statistics? And why do you also, besides your background, why do you also use these old formulas and compare them to the current formulas?
Okay, well, let me just start back in time some. I went to Dartmouth College, the Tuck Business School, and at the Tuck Business School, I got into econometric modeling. I was an economist major, and looked very carefully at the economic statistics as they were published, and found that you could develop models that would predict what was going to happen. But in order to make the predictions, you need to find leading indicators that had some kind of a leading relationship to the final number, and with that you could work out a fair estimate as to, based on what was happening here, that next month you're going to see a certain number here. That included the CPI. The CPI was, I don't have any problems with the way they were doing it. It had been done consistently for decades up into the early 1980s. But then something happened there, which again just happened this year. They had a cost of living adjustment for Social Security recipients. It was calculated using the headline Consumer Price Index, and this was the index that the government had put together to estimate the cost of living of individuals, and it was reasonably good. But the problem here was that back in the early 80s, you had a spike in inflation, and all of a sudden, you're looking at a 4 or 5% increase in the cost of living adjustment the next year. And the people in Congress didn't like that, and rather than do anything to contain inflation, what they did was they looked at ways of redefining inflation to bring down the headline number so that the cost of living adjustments would not be so great going forward. The first item, the biggest item they addressed, was the cost of housing. It used to reflect the actual cost of buying a house and maintaining it and such, but they redefined that whole area as what they now call homeowners equivalent rent, where the government sort of modeled the components. And the effect there was that it knocked something close to 2 percentage points off the headline year-to-year inflation, which at that time was a fair portion of it. But having done that, I took offense at that. Hey, you don't do that. You don't just change the way you calculate things. I had something of an accounting background, and you look at the basic accounting principles. You use consistent accounting over time. You don't change the accounting to make the numbers look better. Nonetheless, that's what the Bureau of Labor Statistics did, and that they continued to evolve there in changing the way they calculated the CPI each time, bringing the change, lowering the change because of the redefinition. So what I did was I looked at what they did, and the government's always been straightforward in terms of what they do, and they put out estimates as to, well, we do this, it's going to knock 1.5 percentage points off the CPI or whatever that number was. So I just tracked their changes And when they made the changes, I reflected that. I mean, I knew I obviously posted the numbers they had, but then I posted back in what the numbers would have been had they not changed it. And that is where the differences have come in over time, because what I call now the ShadowStats alternate index is my estimate of those the government's CPI had they never made those simplifying changes or reduction changes to the CPI that were designed specifically to reduce the headline CPI and to cut Social Security recipients' cost of living adjustments. And that differential over time now is they stopped the changes pretty much in the first decade of the 2000s. Although they may have done something a month or two ago that we'll see what they estimate in terms of its impact. But the aggregate impact is over time has been about 8 percentage points, and that's quite significant. So that what I do every month, I'll put out here's the government's CPI. I give you the list of their numbers. Then I say, and here's what it would have been had they not made these changes. On my, I have an article that shows where the changes were made over time. So it's the changes that I had back in are nothing more than what the government has taken out and said they'd taken out of the CPI. It's that simple.
So the old inflation data, it used to measure a fixed basket of goods. So for someone to go to the grocery store and buy the same types of groceries or buy a house or rent, the basic necessities that an average person would need to survive, to have like basically an average standard of living. But it seems that the input data, John, a lot of it's adjusted. You talked about the different types of adjustments a little bit, but there's also substitution, hedonics, geometric weighting.
Yes.
It seems that all these things that are in there already, it just gives the government like a moving target. So the average person sees the headline number now in today's numbers and says, oh, inflation is down. Oh, the Fed's getting control of it with all these rate hikes. Do you think that that's the case, or do you think the headline numbers that we're seeing out are very, very misleading compared to what's actually in the data?
Well, I think I think they publish their numbers as their formulas show it, but it's what they're showing as a headline inflation is well below what it would be had they measured it in the old by the old standards of maintaining this is what you need to maintain a constant standard of living. That's what they gave up. But that's what had been intended with the Social Security inflation adjustments, was that those inflation adjustments would keep the Social Security payments meeting a certain standard of here's what you need to live on, and this has been this has gone up according to whatever's been in the inflation. They changed the way they calculated the inflation. They abrogated the agreement. Like, what can I tell you? And in the process, they introduced there are all sorts of fine adjustments that are in there over time. But again, every time they make a change, they'll indicate, okay, this is going to add or subtract this from the headline CPI. And usually what it does is it subtracts. They very rarely make a change which increases the headline CPI rate. So that it's what you see with my numbers is an aggregation of all these changes that they started making back in the early 80s up until up through the first decade of the 2000s. What happened in this last period coming out of the pandemic was as they moved from one year to the next, in the year where you were seeing this sharp inflation from the pandemic hit. They had a weighting there that averaged the impact of the pace of the increase, which I think is over 3 years, and that had the effect of slowing down the increase. But as the pandemic inflation subsided, they shifted to a 2-year average, which accelerated the pace downturn. We'll see what difference it made over time, but that hasn't been quantified yet. But the effect there is that you're getting a little lower inflation rate now than you would have seen a year and a half, 2 years ago, the way the things were calculated at that time. But that's not adjusted in my numbers.
But John, it doesn't seem to reflect reality, though. So you mentioned homeowners equivalent rent. But if you speak to someone who didn't lock in a 30-year mortgage a few years ago at around 3%, if they're paying a much higher mortgage servicing cost now at interest rates at these levels, or they're paying much higher rent, I don't think the CPI is going to reflect any of this.
No, they do survey, and they do make their adjustments off it. But your point's well taken. I don't think they catch a lot of that. A lot of that's actually difficult to catch.
And this is why I have a disagreement with so many PhD economists that work for the government. I mean, another egregious one is in healthcare insurance, John. I think the government, these PhD economists that are coming out with the CPI, I think they only measure Medicare and Medicaid reimbursements. I mean, for all of us out here with our healthcare insurance premiums, we're paying more money for worse healthcare insurance, and the CPI isn't reflecting any of this.
Right. Now, the CPI is... Had it been left intact back the way it was in 1981, it would better reflect what's happening. But they saw quickly that they were going to have problems with that, and they just kept eating away the problem areas and shifting them around so that they wouldn't be quite as bothersome and in terms of the higher inflation. But whenever they made the changes, they said, we estimate this will lower the CPI by 0.2% or 0.5% on an annual basis. Again, which is what I reverse engineer into this. They've been very straightforward on it.
Is this in the footnotes? Because I mean, if anyone watches CNBC or Bloomberg News, they don't talk about any of the adjustments that are made. All they discuss at most is a headline number, and that is coming down. The mainstream financial media tends to focus on the headline number only. If a price is falling, I guess the bias tends to be towards anti-inflation, that covering up, saying, oh, inflation's coming down, the Fed has it under control. A couple weeks ago, John, not sure if you saw this on business television, the mainstream financial media was talking constantly about how airline tickets are down 18% year over year. And that's one of the major reasons that inflation is falling, I think, along with used car prices. But then they're in the inflation data. But then anyone who goes and tries to book a trip, they're seeing that the airline tickets are way more expensive than what the CPI is claiming.
Yeah, you can always find things to pull out and make strong your case, whichever way you're arguing on it. But the point is they have not been consistent in their reporting over time, and very, very deliberately so. And they've changed methodologies with the eye towards not increasing the inflation level, but decreasing the reported headline inflation level. I can't think of any area where they've made a change where it had the effect of raising the inflation rate from what it had been reported as before. Let me put it this way: it's in the hands of the politicians. Back in the day when Catherine Abrams headed the Bureau of Labor Statistics, in her memoirs, she mentioned that Newt Gingrich said, "Gee, if you could only find your way to calculate this number this way, we might be able to find more money for the Bureau of Labor Statistics." It was that open. Everything that was done here was designed to bring down the headline inflation because of what it did very specifically to the cost of living adjustments on Social Security, which in turn, the worse the cost on the Social Security, the greater the deficit. So this all got down to the deficit spending and what kind of a deficit are we going to show this year, next year, and the more they could reduce the errant numbers, the better the political picture was created.
I think that's a good point that you brought up about Newt Gingrich. I've heard that on C-SPAN that they were openly discussing this. Republican Congress back then that was controlled by Republicans. They had finally taken back control of Congress, and the Clinton administration, the White House in the early 90s, they wanted to balance the budget. They wanted to show what a budget surplus, that they were trimming government, and they were working together. But one of the ways they were doing that was with changing the inflation data. They wanted to reduce the unfunded liabilities. Now here, 20-something years later, the unfunded liabilities have exploded. Do you think it's fair to say, though, John, I know your data, a lot of your data shows this, but do you think it's fair to say that over the last 15, 20 years, maybe even longer than that, the real inflation rate has been well above 2% for many, many years?
Well, I can tell you precisely. You were having fairly high inflation in the early 80s. It really started to come down after they started making the changes. I mean, if you look in at December, say we look at December of '83, there the government's headline inflation was 3.79% year over year. But if you look at the way it had been done before, it would have been 4.77%. So by that point in time, the changes they'd made in that last year had knocked a full percent off the headline consumer price index, and it tends to, the changes were gradual over time. By the time you get to 1980, you're looking at a year-over-year inflation of 4.7%. Let's say, excuse me, 1990. I'm just looking randomly at numbers here. April 1990 is 4.71% year over year. Based on the old methodologies, it would have been at 7.08. So now you're down to, you're somewhat over 2 percentage points and rising. By the time you get to 2000, you've seen a lot of change here. The headline CPI for January of 2000 was 2.74%, but based on the way it had been reported, the changes had been the changes had been made over time. The reporting had been over time. You were up at 9.2%, and then you have a little more deterioration after that, and after the late early 2000s, they just stopped changing it. So you still had the old method, what would have been using the older original method, and what it was today. And right now, going up through July, the month of July in 2023, which is the most recent number, the headline CPI year over year is 3.18%. My measure, which incorporates all the changes made back through that time in 1980, it would have it up around 11%. And that's a very significant difference.
That's pretty high. That's still pretty high levels.
People have a tough time living on what's supposed to be a comfortable standard of living these days.
Sorry to interrupt you. I just wanted to say for our listeners out there, even 11% is pretty high levels of stagflation. But didn't in 2022, didn't you have the real inflation rate? You had it around 17 or 18%, which is very high levels.
Sure, yes. I mean, it got the peak. Let's see.
I think it was 18%. I think that's the most recent high was around 18% that you had in your data.
It that it's very without getting into this specific. Well, I've got it. I have one here last year at 17.3%, which is pretty close to what you're looking for there. That was in June of 2022. Again, here you have pandemic effect. The headline CPI at that time was 9.1%. So the headline number was up up at 9%. Mine was up at a little bit over 17%. So there's a difference of about 8 percentage points, a little more than 8 percentage points.
That's an absolutely enormous difference. And there were prices that were going up faster than that. I mean, the money supply growth that not just the Federal Reserve Bank in the US, it was all these governments created over a 2.5-year span during the pandemic from 2020 to 2022, many, many trillions. I think M2 here in the United States, in that small time span, it grew by around approximately 40% or over $6 trillion.
Well, in terms of where it is right now, and this is 2023, and it's a little bit in 2023 against where it was pre-pandemic. It's up effectively 40%. But that's not what's driving. It's part of the factor that's driving the inflation now, and the inflation again that we're seeing is not being driven by an overheated economy. It's being driven by the Fed's money supply growth. If you look, what I look at from the standpoint of the inflation driving parts of the money supply, it is the most liquid part. People don't take their time deposits and go out and buy a new suit. What they do is they'll use their cash or their checking accounts, which are the narrower but most liquid money supply measures that effectively cash. Now, some funny things happened when the pandemic hit. You go back to February of 2023, you see this pandemic's coming on. In March, the Fed exploded the money supply. And where we are right now in terms of what is the only measurable, most liquid element of it, which is the cash and the checking accounts, I call it basic M1, which account for about 8% of the total money supply, but it's up by 120% from where it was before the pandemic. Now, when the pandemic hit, what the Fed did, instead of reporting the money supply weekly as it was, it went to a monthly reporting. It shifted it a month further back in time, and then it redefined M1, which used to be the narrow measure of M2. You had M2, which was the aggregate money supply, and then M1, which was the liquid measures such as cash and then checking accounts. They left the cash and the checking accounts in place, but they redefined the interim areas and made everything else M1. So where M1 itself had been around 10%, I think it was 12% of the money supply at that time, all of a sudden it was 88%. So the liquid elements of M1 effectively disappeared. At least you could not measure any other liquid elements on a consistent basis going back in time where you could compare them. What survived the redefinition was what I now call the basic M1, which again is the cash and the checking account. So that's what people buy things with. And if you look at that basic M1 as a percent of the total money supply, M2, which is what they count as their total now, it's at a 53-year high. And it's my contention that it's that liquidity that is driving the inflation. That's what people buy things with, and then you buy things with. That's what drives the inflation. If you're not buying, you're not bidding up prices.
Well, also on the supply side with government policies that prevented new supply from coming online, and now you have higher interest rates. But that liquidity, John, it's also inflated asset prices. The Alan Greenspan Fed, there was a bunch of economists at the Federal Reserve Bank and others like Paul Krugman, others that were openly talking about the wealth effect, I think back in the either 80s or 90s. And it seems that they were started to underreport consumer price inflation because the goals of the government were to start promoting asset price inflation, inflating stocks, bonds, and real estate. And the last couple of decades, John, it seems a lot of this liquidity you're talking about, it's been redirected intentionally into asset prices.
That's a fair statement, yeah.
So you think then that if the inflation, the monetary inflation, the credit, the liquidity is going into asset prices, the government's not going to count that as bad inflation, even if that's creating absolutely enormous wealth disparity for regular people who are listening to this podcast, because then we can't afford to go buy a house, we can't get a mortgage, stock prices are overvalued or inflated.
And that is a problem. And that's, I mean, you've got a whole couple of talk shows with that one. It is, what I'm looking at right now is the basic economy, the basic inflation, and what's driving them, what's real, what isn't.
So do you think then the Fed's going to be able to get the inflation rate down further? Or do you think that with credit contracting, some of the banks in trouble, the consumer tapped out with the credit card interest rates, do you think then that the Fed's going to end up breaking a lot of the real estate and the consumer and causing bank failures then with their current policies?
Well, there are all sorts of ways it might evolve, but I don't think the Fed's going to get this under control. They haven't been able to. In fact, they're talking to say, oh, yes, and I mean, you have Chairman Powell and what I would consider some outright falsehoods, lies, in terms of what was happening. I talk about it, but he needs to tell a story. Now, what he blames the inflation on, when the inflation was rising, was the overheating economy. That was, and it's still, that's still the dogma. The overheating economy. We have to keep the rates high to kill the overheating economy and bring inflation down. That's absolute nonsense. The economy was never overheating. Even if you look at the GDP numbers, let alone headline retail sales, industrial production, construction spending, the cash freight index, adjust that for the government's headline inflation numbers, put it into what they call real terms, and that's the way the economies look at. You still have a recession in retail sales, industrial production, construction, and freight activity. Now, those are four broad areas that tend to reflect what's happening. But unless you've got something booming there, you sure don't have a booming economy. You don't have an overheating economy. What was creating the inflation was this tremendous surge in the money supply. It's not overheating demand. It's not an overheating economy. Sure, you can if you have an overheating economy, you can bring it down by raising interest rates. And what the Fed did with raising its interest rates was that indeed it slowed the economy, and it's put us into a pretty deep recession that we were already in one, but it's now deeper. It is they're in a difficult circumstance because where they're under criticism, say you've got to keep the inflation under control. They're the ones who pushed it out of control with the money supply creation. It was not the overheating economy.
Yeah, I agree. The Fed's going to make things worse.
Here's the problem with the FOMC. It's owned by the banking system. The banks need liquidity. Hence, you pump up the money supply. They need to make money. Hence, you have higher interest rates. The higher interest rates are killing economic activity, but the money supply is what's driving the inflation. It's not the overheating economy, and they know that.
But I would argue
it's just a very difficult circumstance.
Well, but I would argue that because of almost 15 years of zero interest rate policy, that a lot of these regional banks, they can't deal with the higher interest rates. So in the past, if they were just doing regular banking and they were more prudent with their risk control, they might have been okay. But a lot of these regional banks, what they've done with the jumbo mortgages, they give out a lot of jumbo mortgages at 3%. Now with interest rates much higher, they're underwater in that loan book. They're underwater in their commercial real estate loans. They're underwater. They have massive losses probably on small business loans, massive losses on credit card debt, auto loans. I could go on and on and on. And then they have all those older US treasuries they bought from 3, 4, 5 years ago. They have to mark those down. So it seems the Fed's going to maybe unknowingly is going to absolutely destroy the smaller banks.
That could happen. It's not a stable circumstance. I do not see a happy solution in this. In fact, what I think is going to happen is that we're going to see a continued increase in inflation. I know the headline inflation has stabilized some here, but the money supply is not disappearing, and all the issues that are driving that stay in place. I think we're going to see the Fed is increasingly going to have to pump more money into the system. They're going to have higher inflation. They're willing to take a certain amount of that to keep the banking system stable. Where does it get out of control? That remains to be seen, but it's very dangerous. I think you could have an inflation here that goes beyond what the Fed is looking at, or what it can actually can control. It's just a very dangerous circumstance. At the same time, what the Fed has been doing in hiking the interest rates, indeed, is helping to kill the economy. So you have the economy slowing down. I mean, you look at the recent numbers. You can see it in the series I mentioned. Just take it headline, not my numbers. Just take the headline inflation number out of retail sales. Look at industrial production, which is already adjusted for that. Look at the cash freight index, which is also already adjusted for inflation. Look at housing starts and such. That's a physical count of structures. It has nothing to do with the pricing. Although the housing starts is up front in the first couple of months is always a sort of a headline gimmick for the real estate industry, and then it sort of settles down and with realistic numbers. But look at the building permits; those numbers are usually very close, and they rarely get revised. And you're still down 15% from below the pre-pandemic peak. We don't have a healthy economy. It's not getting better, and with what's happening with these inflation numbers and the way it's hitting the different series, we're heading for a weaker economy with higher inflation. It's the worst of all worlds.
Yeah, so you have stagflation, you have taxes, the consumers getting killed. It's also the high interest rates now. So you have over 12 months of record Federal Reserve Bank interest rate increases. The lag effects now are going to be taking hold. You're seeing this with a lot of bankruptcies coming from a lot of small businesses. You're seeing this with the regional bank problems, commercial real estate. There's bad headlines every day, although that's not causing bank failures yet. And then the consumers tapped out. So you're going to see a lot of problems. Oh, the other problem is the mortgage rate. So, I mean, a lot of people now in the last couple of months are starting to, not only are they not selling their homes to cash out because they don't want to go get another home and a higher mortgage, but they're starting to increase home equity loans. Yeah.
Yeah. Well, your points are well taken. It's a very difficult circumstance. And the Fed's in the center of it. I know they'd like to do whatever they could to get a happy resolution there, but their primary function still has to be keeping the banking system afloat.
And also funding the U.S. federal.
That's contrary to what you might want to be doing otherwise.
Well, the Fed also has to make sure the U.S. Treasury gets funded, and the Treasury General account was drained. And can the U.S. Treasury even keep affording, because they have a lot of debt that needs to be refinanced over the next 12, 18, 24 months. Can the U.S. Treasury even afford interest payments on that debt at 5% interest rates if the national debt's going to keep rapidly growing, plus the unfunded liabilities?
Well, it is the people in Washington are creative. They eliminated the debt ceiling in this last deal, so now they can just spend whatever money they want. There's no longer a limit to it. they're going to be feeling they're going to be pumping money into the system same time that the Fed is. It's not a healthy circumstance.
Yeah, I'm wondering who's going to buy the U.S. Treasuries, because I don't see the normal buyers. So China, Japan, Germany, the normal countries that recycle their trade surpluses. Are they going to change the laws so the banks have to buy more Treasuries? I don't really see a lot of, other than retail investors that are moving their checking accounts or savings accounts over to money market funds or to treasurydirect.gov. I don't see a lot of demand for U.S. Treasuries from the normal buyers the last 15 or 20 years. I think eventually, John, the Fed's going to have to do a 180 on their balance sheet, and the Fed's going to have to buy a lot of these Treasuries.
They probably will. I'm not arguing with it, but someone has to, and they can create the money. It's not a circumstance that has a happy ending in a well-balanced economy, well-balanced inflation. I see the inflation getting out of control here. I think the dollar is going to decrease significantly in its value against the rest of the world and rest of the world's currencies. It's a time when you might look outside the bounds of the normal Wall Street hype as to what you need to do, and I think it'd be a good idea. I think it's very simply a very good idea to hold some physical gold as a hedge against what probably is going to be a very high inflationary environment here. That would be what I would look at, but.
Well, also other commodities, but actually I wanted to ask you about that. So I know for years you've been predicting hyperinflation, and we haven't had anything even close to hyperinflation yet. I would argue in 2022, we had really, really bad stagflation. The government's been trying to reduce the inflation rate with different policies. It seems the inflation rate is still pretty high compared to what the CPI is saying, and then taxes are going up for the average person on so many different things. So in your opinion, why haven't we had hyperinflation yet over the last 10 and 15 years? Because I know you've been predicting it for a number of years already.
Well, the problem, what I've been predicting, it has been based upon the basic fact of the long-term insolvency of the U.S. government. It's just a matter of when that all comes into play, and I think it's accelerating very quickly here. It's always been prospective, but it is, again, the hedge there historically, and I have no reason to doubt it otherwise at this point, is in the holding of the physical gold. It will historically preserve the purchasing powers of the currencies of the people who have bought it and had a problem with their currencies being debased. Our currency right now is being debased, both by the Federal Reserve and the excessive money growth, and by the federal government with its unlimited, no budget cap, no debt limit spending.
Oh yeah,
we have higher inflation ahead of us.
Yeah, I totally agree. DC, reckless spending, both political parties. There's almost no one in either political party who's actually talking about serious spending cuts.
No. It's an extraordinary circumstance. It's a very difficult circumstance. Both from an upfront practical and also accordingly with the political. I mean, there are easy practical solutions. People be taking them, but the practical begins to disappear, which it has been doing increasingly here. A very difficult circumstance.
Well, the rational thing for governments in the past would be to reduce government spending, but the exact opposite is occurring. I mean, the people, John, are here in DC, the politicians, the bureaucrats, a lot of them, the lobbyists, they're all talking about increasing spending, or almost all of them are talking about new programs to increase spending. I don't know how they figure things are going to get paid for if they're just going to tax us to death, increase taxes, and debase the dollar even further. But no one's actually talking about serious spending cuts. They're all coming up with their projects for spending. I mean, talking about Green New Deal and all these other projects.
Yep. Well, it's you're pointing out the shortfall in what they're doing, and that is that that are not going to be able to pay for it other than creating money, which means inflation. And
or if they tax us directly, they're going to destroy their whole economy too.
It's I think as they look at it, is it better that we keep things afloat now and maybe pay for this down the road, or do we take the hit now and then be more stable down the road? They don't want to take the hit up front. They know politically it'll kill them, and maybe something else will work out. At least I think that's what they're looking for.
Well, especially if you're here in DC and in 5 or 10 years of being in Congress and the House of Representatives or the Senate, you can make an extra $10 million on side deals or insider stock market trading.
Sounds good.
So I want to transition now to the jobs report. So I hear people talk about the birth-death model. What is the birth-death model, and does it reflect reality that jobs are actually being created?
Well, it is. It's been modeled, and there's some legitimacy to it. Whether it's accurate or not, I would tend to say not, and the biases would tend to be on the positive side for the good news in terms of the employment numbers, but they do benchmark, and again, I've been doing this too long. When I started looking at these numbers, I would go down to Washington and talk to the fellow at the Bureau of Labor Statistics who put together the payroll numbers and benchmark revisions, and they had their offices in the city. Now they're all out in Maryland and God knows where. But they're always very honest, straightforward people. They'd talk with you. They'd explain things. And one year, it is fairly early on, but they'd been watching it long enough. They came in with the payroll benchmark revisions. Do this every year. And the effect was the level of payrolls was revised lower for the prior year. And that was a fairly consistent pattern that if you looked at it year after year after year, each year you tended to get some downside benchmark revision. And this is long ago, and a number of administrations
sorry to interrupt you. So for the layman out there, what does downside benchmark revision mean? Does that mean like 1 month, 2 months, 3 months later, the supposed headline number that said like 250,000 jobs?
No, this is the annual benchmark revision. They go back and revise the prior year's numbers. And so the benchmark revision going back the year to the year before, you would see a downside revision to the at least the earlier numbers of the year before. And overall for the year, they would revise lower.
The reason I asked this, John, I'm sure you know this because you cover this, you do this with your newsletter for a living at ShadowStats, is that 1 month, 2 months, 3 months later with these jobs reports, people see the headlines, like the headlines will come out in the next couple of weeks and it'll say the jobs report, 250,000 or 300,000 jobs were created. But then a month, 2 months, 3 months later, the numbers are revised downward and it's like the jobs never were created at all.
That is correct. But when I was looking at it, and when I talked with the people working with it, and I suspect you'll see similar rationales today, but I would say because you got the annual benchmark revisions always to the downside, which meant they had overstated the payrolls to the upside the prior year. And I said, why is it every year that you revise it to the downside? And the guy was very open with him. He said, I'd be fired otherwise.
Sounds like a Soviet Union economist, one of the ones I interviewed years ago.
Well, the way he explained it to me, he said, if I revised the numbers higher, it meant I understated the payrolls. And that would hurt my boss politically. I guess presumably up the chain to the President of the United States. So they always, it was much better to have overly positive numbers as opposed to having negative numbers against reality. And it was so
It
downside
seems
benchmark revision, you're okay. If you had to revise upward, you lost your job. Meant you hadn't been doing your job in terms of reporting good numbers.
Yeah, it seems DC has a bias and is very anti-recession. So the politicians don't want the jobs numbers to look bad, the headline numbers, and they don't want the R word, the recession word, because then that means they won't get the votes because it's not creating jobs. So they have these headline numbers that say that jobs are created, but the reality for a lot of my young adult listeners that are listening to this program who are in college or just graduated, they have gig economy jobs. So they don't have a high paying full-time job. They have a couple, 1 or 2 or 3 part-time jobs, and they're trying to put a life together as an adult outside of college with that, with a couple gig economy jobs. Are those part-time gig economy jobs, are those counted the same in the jobs report as a full-time job?
Yes. I mean, in terms of the payroll count, it is.
Yeah, anyone who has those part-time jobs knows that you're not getting a high salary, you're not getting a high hourly wage, you're not getting the same type of benefits for a retirement account and healthcare insurance. It's just ridiculous that they're counted the same.
Well, it's there are other measures in the numbers, but basically it's a rigged number. Well, what can I tell you? They
Well, wasn't there
those are different surveys. They get counts against the states. The states play their games. I think the biases are probably fairly consistent over time. So you can tell if you're doing better or worse than you were, but when you get the year-end revisions, which then bring in line in theory with what had been reported, let's say the year before, all of a sudden it doesn't appear to have been as strong as it was.
Oh, yeah, I 100% agree that it's rigged. There was actually a whistleblower, I think, at the Department of Labor Statistics who was in the Obama administration who said he was pressured by all the higher-ups in the Obama White House to rig the jobs numbers to help him get a reelection.
That would not surprise me. I knew, there's some people, some presidents have been a little more adept at the numbers than others. The Clintons were masterful, and I know that from people who were involved with the numbers. Richard Nixon was not so masterful. He had. I think he was told first go around here that the unemployment rate was such and such, seasonally adjusted, and was a little better unadjusted. And he says, "Well, let's just report the unadjusted number." They wouldn't do that, but that didn't. That was not an extraordinarily sophisticated manipulation. There have been manipulations that have just been out of pocket. I mean, it's done very deliberately to make things look better. Usually make things look better. There may have been some the other way with other politics, but I mean, I know specific instances where the numbers have been very positively upgraded from where they would have been otherwise had you gotten honest reporting.
Yeah, it seems there's so many adjustments, John, to all this data with inflation, all the changes and substitutions. It sounds like they are disclosing it, but people have to look way beyond the headline numbers. They have to go read the footnotes or talk to the PhD economists. But that's not what's being covered in the mainstream financial media, the headlines. So people only talk about the headline number and the downtrend for the headline number. In your opinion, though, I want to transition now to GDP as we kind of wrap up towards this interview. Are we headed towards a GDP now where the U.S. federal government spending is going to account for 50% or more of the GDP?
I'm sure what is going to account for
U.S. federal government spending. So in the last 12 months, I know you look at the jobs data, isn't the majority of jobs that have been created in the U.S., they've been government jobs the last 12 months. So isn't government spending headed towards 50% or more of the GDP, depending upon how it's measured?
I haven't taken a direct measurement of that, but I could believe that's the case, yes.
That doesn't sound like...
If you've seen that, I'll go along with you on that. And
well, it's getting close. It depends how you measure it. So it depends how you measure it with transfer payments and government employee salaries. It's getting really close to 50%. I think
you're looking at nominal or after inflation adjustment.
Well, that's the other problem, John, isn't the GDP numbers, aren't they using a deflator? They're not even using the CPI, right? So if they adjusted GDP for just the CPI, wouldn't GDP already be negative?
Well, it would be. On the other hand, the CPI is a very specific measure of consumer prices. There are other areas where you have inflation that don't get into the CPI. The CPI is specific to the consumer spending, but it's the consumer price index with its implications for the adjustments to things such as Social Security payments and such that is the most politically sensitive and where the games have been played very heavily to understate it. I mean, there are other areas that I don't get into all the inflation measures as I do with the CPI, because the CPI is so closely tied to what's happening to the consumers and their income adjustments, the things that the government spends going forward. All the CPI is a central figure for the government with its the way it looks at many of its fiscal operations, calculations, and such. But there are other areas. For example, you look at the I think we're briefly discussing the GDP price deflator. Now, of course, it's weighted on a different basis, but there are elements of that which do show slower inflation. The overall GDP inflation would not be as high as the consumer inflation, but it's has to do with the way consumers spend their money.
Yeah, I mean, the GDP is definitely deflated, and then they use the base effects for the CPI, but the GDP, the real GDP, is negative if anyone used anything close to your real inflation rate or even CPI. And I think that's why these credit ratings agencies are starting to get really worried looking at things like this, saying, hey, bond yields are up, but foreigners aren't buying the treasuries. DC is spending like crazy. The Fed says it's reducing their balance sheet. If they used what a normal CPI calculation, GDP would be negative. The government wants to keep spending. All these factors here, it's starting to look pretty bad for U.S. federal government spending.
It is, yes, no question. I mean, it's a very dangerous circumstance. That's why, and knowing, I mean, we've seen elements of the political spectrum that will be affecting where we go here. Again, you come up with they couldn't balance they couldn't work out the deficit spending, so they blew away the debt ceiling. Now that's brilliant. So you're guaranteed now much higher government spending, and that will indeed be an added factor in the inflation beyond what people were looking at before. Of course, they kept shutting the government down or moaning, no, we can't have this program, that program. They're just going ahead full blast now. Well, and that I see this is very dangerous in terms of inflation. You add that to what the Fed is doing. The Fed could not be increasing the money supply. It could be tightening up, and it would hurt the banking system. But the banking system owns the Fed. The banking system needs to be able to function. They need to be able to make money. It's a difficult circumstance, and all the people here who are able to make decisions are making the decisions in basically in the favor. Yep, we got to have this. This has to survive. This has to survive. And the problem is that that's inconsistent with having a stable inflationary environment going forward. So the decisions that I'm seeing being made, both at the federal government level and with the Federal Reserve, all are looking to feed inflation here at the in order to keep the consumer side as happy as possible.
Well, I think they're going to kill the consumer now, because there's still inflation, as we see with your data, with the real inflation rates, that the consumer is still dealing with stagflation. And I would also argue a lot of shrinkflation, which I don't think the consumer price index measures shrinkflation accurately also. But now on top of the inflation, the consumer is also dealing with high interest rates. And there's a lot of people with at least, I think the average balance is $6,000 of credit card debt at over 20% or more interest rates now. So the absolutely unbelievable levels of credit card debt and servicing the credit card debt.
Yep. That's a difficult circumstance. I don't see an easy solution to it with the current people we have in the system, and a solution would otherwise be more of I think, an economic constraint, which would not be popular. But if you want to stabilize the system and the monetary system, you need to start to bring things back into balance. It's politically extraordinarily difficult.
I don't think with a debt-based fiat currency and fractional reserve banking and a lot of the large banks gambling in the derivatives casino, and they're basically hedge funds, and then 300 trillion in global debt. I don't see any type of balance or normalcy or stability here. I mean, the system is it gets more fragile. Really, since it seems that the things have just gotten even worse since 2008, and then they got worse again in 2019 and 2020 through 2022. Just worse and worse and worse. The system is incredibly fragile, but the solution, I'm using air quotes here, John, is to just keep debasing the currency and doing bailouts.
Well, that's what they're doing, and the debasement is beginning to accelerate. That's again, that's where you eventually end up with the hyperinflation. Politically, it's very difficult to fight the inflation, but you go through what they went through in Germany. A century ago. It is probably something that people in retrospect would say, well, I'm glad we had a shakeout there, and maybe it was better just to cut back and be stable as opposed to letting everything just blow apart. Because if you get a hyperinflation, the things that retain value are so-called real assets, real estate, gold and silver, for example. And of course, how liquid things are even affects the values there. I mean, if you have a frozen real estate market, the real estate will have its value, but you may not be able to move it. So it's very dangerous times. A good time to stay reasonably liquid, and again, as I look at it, holding some precious metals physically.
Well, those other hyperinflation events you mentioned, those other countries were either emerging markets, or they were countries that had war reparations debt or war debt that was normally in a foreign currency. So those other countries, they owed, in a lot of cases, it was dollar-denominated debt. So they were either the Weimar hyperinflation or an emerging market country like in Argentina or Venezuela, or some of the other Asian tiger crises, they owed a lot of their debts in dollar denominated debt, but their local currency, they didn't have the dollars. So I think the situation is a little bit different. We haven't had really a hyperinflation of a world reserve currency before. And there's so much dollar denominated debt out there globally, John. There's many trillions. I don't know the exact number. There's tens of trillions. That creates demand for dollars. So the whole system is messed up. I think like the best case scenario is stagflation, but we could have much worse.
Well, I hope you're right. I mean, that sounds like a terrible thing to say, but I understand your point.
Well, I think a lot of the hyperinflationists, and actually I was in like 10, 15 years ago, I was in the hyperinflation camp with Peter Schiff and a lot of those guys. But then as I learned more about the system with the euro dollar market, the dollar denominated debt outside, I started to understand that the people in power in DC and the large banks here in the US could get away with a lot. So they could really just get away with stagflation, either low levels or 9, 10% levels for a long period of time. And most people wouldn't notice, as long as that didn't hit consumer prices for the most part, as long as that went into asset prices. But here we are now, John, the last 3 or 4 years, most people, and I know with your data, the consumer prices were going up a long time. There was shrinkflation and stagflation for many years, but most people didn't realize it until the last couple of years, how bad it was.
Yeah. Well,
so I think now a lot of people are finally starting to realize how bad the system is, that there's a lot more inflation, stagflation, shrinkflation than people realize. And now more people are waking up that, hey, there is bad inflation. Look at the Google searches, search for inflation and stagflation in the last couple of years. More people are waking up. Yeah, I don't know. I honestly don't know, John, how much longer that they can keep this kind of, I call it stagflate, taxlight. I don't know how long the people in power can keep the system in place. It's so fragile because we've gone, from 2008, there was around 200 trillion in total global debt. Now here, 15 years later, about 300 trillion. So I don't know how much longer they can keep the system in place.
Well, when things do blow apart in a system, usually it comes pretty quickly, and sometimes it's triggered by something that you're not really looking at specifically, but it's a type of thing that you knew could happen, and something does happen, and it catches the system off guard, even though it's prepared for things like that. It is a type of circumstance that could evolve very quickly, and I'm not saying specifically that it's going to happen. It's going to happen in the next 2 to 3 months here, but the risks have been increasing sharply in the last year or so. And if you see things evolving as they have the last year or two, I'd be very happy to see the system get through another year or two of that without a major financial implosion of some form, either the hyperinflation or some other kind of collapse.
It's actually looking, John, like there might be hyperinflation or a collapse in a currency or a collapse in the economy of other countries first before the US. So, but those problems will eventually come to the US because a lot of the US banks have a lot of bad loans and bad investments outside the US too. And the banking system.
That's a good possibility, yes.
Well, I really enjoyed our discussion today, John. Let's definitely have you back on again soon. I think I could talk about all the problems with all the government economic data for hours. If my listeners want to follow your work, your excellent work at ShadowStats, how do they do so?
Well, first I want to thank you, and I've had a very interesting time here with you as well. I'm in an unusual circumstance where my website, ShadowStats.com, has been on a web hosting service for 20 plus years, and they just went out of business. And my programs are not all up to date. So right now, if you go to my website, you'll see effectively the basic homepage, and all the archives are there. But I have what I have done is I have set up for my subscribers at the moment an email service that gives them all the commentaries, all the numbers, the graphs, and we're getting the site back to normal. But if someone's interested, just drop me a note at John Williams at ShadowStats.com. I'll set you up with what we have, and you can see exactly what's going on. All the information that I've been putting out on the site, I'm just providing that to people by email, and always happy to talk on the telephone, 707-763-5786. John Williams, ShadowStats.com. And again, the email is johnwilliams@shadowstats.com. Always happy to talk with you, dig in as to what we're looking at, and show you what products we have. Never been overly expensive. It's $175 a year for the full service, $89 for 6 months.